Let me tell you something that Wall Street doesn't want you to know. The biggest financial scam in America isn't happening in back alleys or shady offshore accounts. It's happening in boardrooms, in pension funds, in institutional investment committees across this country. And it's being sold to you as sophisticated investing. I'm talking about private equity. The industry that manages trillions of your dollars while enriching themselves through fees that would make a mob boss blush. My name is Robert Kiyosaki, and I've spent decades teaching people about money, about investing, about how the rich get richer while everyone else gets poor. And one of the biggest mechanisms for this wealth transfer is private equity. Today, I'm going to pull back the curtain on this industry. I'm going to show you exactly how they're stealing from you, how they're lying about returns, how they're getting rich regardless of whether you make money or lose everything, because the dirty secret of private equity is this: they don't need you to make money. They just need you to give them money. And once you understand how this game works, you'll never look at institutional investing the same way again. Let me start with a story that perfectly illustrates everything wrong with private equity. There's this wonderful parable I heard from Charlie Munger. A man has a horse, beautiful animal, rides well most of the time. But occasionally, this horse goes crazy, throws people off, breaks arms and legs, causes enormous damage. The owner goes to the vet and asks what he should do about this dangerous horse. The vet says, "That's easy. Next time the horse is behaving well, sell it." Think about the morality of that advice for a second. You have something dangerous, something that's going to hurt people. And the solution is to pass it on to someone else before the danger becomes obvious. That's exactly what private equity does. They buy businesses, load them with debt, extract fees at every step, and then sell them to the next sucker before the whole thing collapses. And they call this sophisticated investing. Now, before I go further, let me explain what private equity actually is, because most people don't really understand the business model. Private equity firms raise money from investors. These investors are usually pension funds, endowments, wealthy individuals, family offices, people with a lot of capital looking for higher returns than they can get in public markets. The private equity firm takes this money and buys companies. They typically use a lot of debt to amplify their buying power. If they raise $1 billion, they might borrow another $2 billion, giving them $3 billion of purchasing power. They buy these companies, make changes to improve profitability, and then sell them a few years later, hopefully for more than they paid. That's the story they tell. And on the surface, it sounds reasonable. But here's where it gets dirty. Here's where the dishonesty comes in. Private equity firms charge fees at every single step of this process. They charge a management fee just for holding your money, typically 1.5% to 2% per year of committed capital. Let me break down what that means. If you commit $1 billion to a private equity fund, they're taking $15 to $20 million per year in management fees every year. Whether they make you money or not, if they lock up your money for 10 years, which is typical, they've taken $150 to $200 million in fees before they've created a single dollar of value. But it gets worse. They also charge performance fees, typically 20% of profits above a certain threshold. This is called carried interest. So if they make money, they take 20% of the gains. But if they lose money, they still keep all those management fees. Heads they win, tails you lose. But even that's not the whole story, because private equity firms also charge fees to the companies they buy. They charge transaction fees when they buy a company, monitoring fees while they own it, advisory fees for strategic advice, exit fees when they sell it. These fees come out of the company, which means they come out of your returns, but they're not always disclosed clearly in the return calculations. So the private equity firm is collecting fees from you as the investor and fees from the companies they buy with your money. This is what I call legal theft. It's not illegal, but it should be. Now, you might be thinking, okay, Robert, but if they're generating great returns, aren't those fees justified? And that's where the dishonesty really kicks in. Because the way private equity firms calculate returns is fundamentally misleading. Let me explain how this works, because it's important. When you invest in a private equity fund, you don't hand over all your money at once. You commit to investing a certain amount, let's say $10 million, but the fund calls that capital over time as they find deals to invest in. So you might commit $10 million, but in year one, they only call $2 million. You keep the other $8 million in treasury bills or some safe investment, earning maybe 3 or 4%, waiting for them to call it. Now here's the scam. When the private equity firm calculates their returns, they use something called internal rate of return, or IRR. And the way IRR is calculated, it only counts the money from the moment they call it. So that $8 million sitting in treasury bills earning 3% for 2 years before they call it, that doesn't count against our returns. But you're paying management fees on the full $10 million from day one. You committed $10 million, so you're paying fees on $10 million, even though $8 million is just sitting there earning nothing. This makes the returns look much better than they actually are. If I told you I was going to invest your money and generate 20% returns, but then I only invested half your money and left the other half in treasury bills, would you be impressed with my 20% returns? Of course not. Your actual return would be much lower because half your money wasn't working. But that's exactly what private equity does. And they get away with it because IRR calculations don't account for uninvested capital. This is what Warren Buffett was talking about when he said private equity returns are not calculated in a manner he would regard as honest. Buffett is too polite to call it fraud, but I'm not. It's fraud. Legal fraud, but fraud nonetheless. Let me give you a concrete example to make this crystal clear. Let's say you commit $100 million to a private equity fund. They call $20 million in year one, invest it, and generate great returns on that $20 million. Your other $80 million sits in treasury bills for 3 years, earning minimal returns while you pay management fees on the full $100 million. When they calculate their IRR, it looks fantastic, 20, 30, maybe even 40% returns. But your actual return, accounting for the fact that most of your money sat uninvested for years, is much lower, maybe 10 or 12%. You could have gotten that in the stock market without paying outrageous fees and locking up your money for a decade. But the private equity firm will wave around their IRR numbers, claim they're investment geniuses, and use those numbers to raise the next fund at even higher fees. This is the game, and it's been going on for decades. Now, you might ask, who falls for this? Who's dumb enough to keep investing in private equity when the math doesn't work? The answer is pension funds, public employee pension funds. The money that's supposed to fund teacher retirements, police officer retirements, firefighter retirements. And the reason they fall for it isn't because the people running these funds are stupid. It's because the incentive structure is broken. Let me explain how this works, because it's crucial to understanding why this scam persists. The people who manage pension funds are not investing their own money. They're investing other people's money. Specifically, they're investing money that belongs to future retirees. These pension fund managers are under enormous pressure to generate returns because most pension funds are underfunded. They've promised more in benefits than they have in assets. So they need high returns to close that gap. They need to show their boards and the public that they're doing everything possible to meet their obligations. Private equity firms come to them with a seductive pitch. We can get you higher returns in the stock market. We have special expertise. We have access to deals you can't get. We're sophisticated investors who can generate alpha. The pension fund manager wants to believe this story, because if it's true, it solves their problem. If private equity can generate 15 or 20% returns, the pension fund can close its funding gap. So they commit money to private equity, lots of money, billions of dollars. And here's the key part. For the first several years, the pension fund manager looks like a genius because private equity funds don't mark their investments to market in real time like stocks do. If you own stocks and the market crashes, your portfolio value drops immediately. Everyone can see the loss. But if you own private equity investments, the fund manager decides what they're worth. They use models and projections and assumptions to value the companies they own. And guess what? Those valuations tend to be optimistic, especially during good times, especially when the fund manager wants to raise more money. So even if the underlying businesses are struggling, the reported value stays high. The pension fund manager can show his board these stable, growing returns from private equity. He looks smart. He keeps his job. The fact that those returns are largely fictional doesn't matter, because by the time the truth comes out, years later, when the investments are finally sold, different people are in charge. The original decision makers have moved on. They got their bonuses for the years when private equity looked great on paper. Someone else deals with the disappointing final returns. This is what I mean when I say the incentive structure is broken. The people making the decisions don't bear the consequences of those decisions. And private equity firms understand this perfectly. They're not selling performance. They're selling the illusion of performance. They're selling something that looks good in presentations and annual reports, even if it doesn't work in reality. I saw this firsthand in Omaha. The Omaha Public School Retirement Fund was doing fine. They had a manager who was investing conservatively, generating decent returns, not taking crazy risk. But then someone decided they needed to be more sophisticated. They needed to chase higher returns. They started investing in private equity and alternative investments. And what happened? The fund got destroyed. The returns were terrible. The fees were astronomical. The whole thing was a disaster. But the people who made those decisions, they moved on. They're fine. It's the teachers whose retirement funds got decimated who are paying the price. This happens over and over again in pension funds across the country. Billions of dollars flowing into private equity, generating huge fees for the private equity firms, mediocre returns for the investors, and devastating outcomes for the actual beneficiaries. And nobody goes to jail. Nobody gets punished because it's all legal. That's what makes me so angry about this industry. It's not back alley fraud. It's boardroom fraud. It's fraud with PowerPoint presentations and fancy offices and Harvard MBAs. Now let me talk about another dirty trick private equity uses. Leverage. Private equity firms love to talk about how they create value through operational improvements. They bring in new management, streamline operations, implement best practices. Sometimes that's true, but more often the returns they generate come from leverage, from debt. Here's how it works. They buy a company using mostly borrowed money. Let's say they buy a company for $1 billion. They put up $200 million of equity and borrow $800 million. Then they make that company borrow even more money. They use that borrowed money to pay themselves dividends, so they get their initial investment back almost immediately, all from debt loaded onto the company. Now they own a company that they've taken all their money out of. If the company succeeds, great, they make a fortune. If it fails, well, it's the lenders who lose money. The private equity firm already got paid. This is what happened to Toys R Us. Private equity firms bought it, loaded it with debt, paid themselves huge dividends, and then the company couldn't service its debt and went bankrupt. Thousands of employees lost their jobs, vendors lost money, customers lost the store they loved, but the private equity firms, they made money because they'd already extracted their capital through debt-financed dividends. This is what I call predatory capitalism. It's not building value, it's extracting value. It's stripping assets and leaving a corpse, and they do it over and over again. Different companies, same playbook. Buy with leverage, extract cash through dividends, sell or bankrupt, move on to the next target. The people running these firms are not investors in the traditional sense. They're not building businesses for the long term. They're financial engineers extracting maximum fees in minimum time. And pension funds keep giving them money because they don't understand the game being played. Now, I want to talk about another aspect of private equity that bothers me, the carried interest loophole. Private equity managers pay taxes on their performance fees at capital gains rates, not ordinary income rates. This means they pay 15 or 20% tax instead of the 37% that ordinary income would be taxed at. But here's the thing. These performance fees aren't really capital gains. They're not investing their own money and earning returns on it. They're managing other people's money and taking a cut of the profits. That's labor income. That's compensation for services rendered. It should be taxed as ordinary income. But through lobbying and political connections, private equity has convinced Congress that these fees should be treated as capital gains. This costs the government billions of dollars in lost tax revenue every year, money that could fund schools, infrastructure, health care. Instead, it's going into the pockets of private equity managers who are already making tens or hundreds of millions of dollars per year. This is legalized tax evasion. And it's only possible because private equity firms have spent millions lobbying politicians to protect this loophole. Follow the money, and you'll see why nothing changes. The industry is too profitable, too politically connected, too embedded in the system. Now let me address what some people might be thinking. What about the successful private equity investments? What about the companies that were turned around? What about the jobs created? Yes, there are examples of private equity firms that do good work, that genuinely improve businesses, that create value for everyone involved. But these are the exceptions, not the rule. For every success story, there are multiple disasters that you never hear about. And even the successes often involve tactics that I find questionable. Layoffs, benefit cuts, extracting maximum profit in minimum time rather than building sustainable businesses. The private equity model is fundamentally short-term. Buy, improve, sell within 3 to 7 years. That's not enough time to build truly great businesses. Great businesses are built over decades, not years. They're built by patient capital that's willing to invest for the long term, to weather downturns, to prioritize sustainable growth over quick profits. Private equity is the opposite of that. It's quarterly capitalism on steroids. It's financial engineering masquerading as value creation. And the worst part is that it's sold to pension funds as a sophisticated investment strategy, as something that ordinary investors couldn't access, as something that requires special expertise. It's all marketing, all sales, all about separating you from your money. I've been in business for over 40 years. I've seen every kind of financial scheme imaginable. And private equity, in its current form, is one of the biggest scams I've ever witnessed, because it's not small-time fraud. It's not Bernie Madoff stealing from a few thousand wealthy people. This is trillions of dollars. This is public pension funds. This is teacher retirement money, police retirement money, firefighter retirement money. This is money that belongs to working people who trusted their pension fund managers to invest it wisely. And those pension fund managers are handing it over to private equity firms who are extracting enormous fees whether the investments succeed or fail. Let me give you some numbers to show you the scale of this problem. There's at least $1 trillion committed to private equity funds right now, probably more. If you account for leverage, you're talking about $3 trillion of buying power. The firms managing this money are collecting tens of billions of dollars in annual fees. Just management fees alone, at 1.5% to 2% of committed capital, means $15 to $20 billion per year. Add in performance, fees, transaction fees, monitoring fees, and you're probably looking at $40 to $50 billion per year in total fees flowing to private equity firms. That's money coming out of investment returns, money that should be going to pensioners but is instead going to private equity managers. Over a 20-year period, we're talking about $1 trillion in fees. $1 trillion transferred from pension beneficiaries to private equity firms. And for what? Returns that, when honestly calculated, are often no better than what you could get in an index fund. If pension funds had just invested in the S&P 500 and held it, they would have generated comparable returns with a tiny fraction of the fees. But that's not sexy. That doesn't involve fancy presentations from Harvard MBAs. That doesn't make the pension fund manager look sophisticated, so they pay the fees, they chase the illusion of superior returns, and private equity firms laugh all the way to the bank. Now, some people will say, I'm being too harsh. that I'm painting with too broad a brush, that not all private equity firms are the same. And they're right. There are differences between firms. Some are more honest than others. Some genuinely try to create value rather than just extract fees. But the fundamental business model is still broken. The incentive structure still rewards gathering assets and collecting fees rather than generating genuine returns. As long as you can charge 1.5% per year on committed capital, you're making money whether your investments succeed or fail. If you raise $10 billion, you're collecting $150 million per year. Lock that money up for 10 years, and you've collected $1.5 billion in management fees. Even if your investments completely fail, even if you lose every dollar, you personally are walking away with over $1 billion in fees. What's your incentive to take risk? What's your incentive to be conservative? What's your incentive to actually generate returns? There isn't one. Your incentive is to raise as much money as possible and lock it up for as long as possible. Everything after that is gravy. This is what Warren Buffett was talking about when he told that story. Someone asked a private equity manager, how can you justify charging 2 and 20 when you haven't proven you can beat the market? The manager responded, because I can't get 3 and 30. That's the mentality. Charge whatever the market will bear. The returns are secondary. This is not investing. This is wealth extraction. This is a transfer mechanism from pension funds to private equity managers. And it's all enabled by pension fund boards who don't understand what they're buying, consultants who get paid to recommend private equity, and a regulatory environment that allows misleading return calculations. So what's the solution? How do we fix this broken system? First, we need honest return calculations. No more IRR games. Returns should be calculated on total committed capital from day one, not just on capital when it's called. If I commit $100 million, my return should be calculated on that full $100 million from the day I make the commitment, not on $20 million from year one and $40 million from year three. This would make private equity returns look much less impressive, which is exactly why they fight so hard against this type of calculation. Second, we need fee transparency. All fees, including fees charged to portfolio companies, should be disclosed and counted against returns. No more hiding transaction fees and monitoring fees in the acquired companies. No more double dipping where the private equity firm charges fees to investors and fees to companies. Full transparency on every dollar extracted from the system. Third, we need to eliminate the carried interest loophole. Performance fees should be taxed as ordinary income, not capital gains. These are management fees, not investment returns on personal capital. They should be taxed accordingly. Fourth, pension funds need to be more skeptical. They need to ask harder questions. They need to demand better terms. If private equity firms are truly generating superior returns, they should be willing to reduce their fees. They should be willing to accept more transparency. They should be willing to tie their compensation to actual performance net of all fees, but they won't do any of that voluntarily because the current system is too profitable. So pension funds need to walk away. They need to say, we're not paying these fees anymore. We're not accepting these misleading return calculations. We're not locking up our capital for a decade while you collect guaranteed fees. If enough pension funds did this, if enough capital left the private equity industry, the fee structures would change overnight. But that requires courage. It requires pension. Fund managers who are willing to say no to the sales pitch, who are willing to resist the peer pressure of what other funds are doing. And frankly, I'm not optimistic that will happen because the people making these decisions don't bear the cost of their mistakes. By the time the poor returns become obvious, they've moved on to other jobs. Someone else deals with the consequences. This is the fundamental problem with institutional investing, the separation between decision makers and the people who bear the consequences. In my world, in entrepreneurship and real estate investing, I invest my own money. If I make a bad decision, I pay the price. That keeps me honest. That makes me careful. But pension fund managers are investing other people's money. If they make bad decisions, they still get their salary and bonus. The retirees pay the price. Until that changes, until we align incentives properly, the private equity scam will continue. So what should you do with this information? If you're an individual investor, stay away from private equity unless you fully understand the fee structure and have the ability to evaluate whether the returns justify those fees. Most people don't have that expertise. Most people would be better off in low-cost index funds. If you're a pensioner, start asking questions. Ask your pension fund how much money is allocated to private equity, what fees are being paid, what the actual returns have been calculated honestly. Put pressure on your pension board to be more transparent and more skeptical of private equity sales pitches. If you're a pension fund manager, do your job. Protect the beneficiary's money. Don't chase the latest investment fad. Don't get seduced by sales pitches. Demand honest return calculations. Demand fee transparency. And if private equity firms won't give you reasonable terms, walk away. There are plenty of other ways to invest money. You don't need private equity. The industry has convinced you that you need them, that sophisticated investors allocate to alternative investments, that you're missing out if you don't have private equity exposure. It's all marketing. Don't fall for it. Private equity in its current form is typically dishonest. Not always, not every firm, but the industry as a whole is built on misleading return calculations and excessive fees. And until that changes, your money is better off somewhere else.